Good afternoon, everyone. So my name's Iden Asl. I'm a partner in the Special Situations and Litigation Funding team at Brown Rudnick. Welcome to this session on seed funding, co-funding, and secondary syndication strategies. So as the litigation finance market continues to mature, we're seeing a growing appetite for liquidity, portfolio diversification, and risk transfer, and with that, the growth of the secondary market. So today we'll explore what's driving that market, how deals are structured, some of the transactional challenges, and where we see this going. We've got a distinguished panel of investors and funders who are at the forefront of these developments, and I'd like to now invite them to each introduce themselves and their institutions. Perhaps we can start at the end there.
Good afternoon, my name's Stephen Friel. I'm the London-based CEO of Woodsford.
Hello, I am Caroline Sealer. I am a founding partner at Ignitis, and we focus just on seed funding. So I'm a recovering litigator, but now turned funder.
Charles Jeffery. I'm the managing director of Jeffery Capital. We're a portfolio and fund management firm based here in London.
My name is John Kull. I'm a portfolio manager on behalf of Omni Bridgeway.
Thank you. So to get the conversation started, I think it makes sense to start with seed funding. Caroline, if I could come to you and if you could talk us through your investment strategy.
Yeah, so like I said, we only focus on seed funding. Back when I was litigating, we would always run into this chicken or the egg problem. You know, you're developing these cases, you want to get them funded, but in order to get funding, it also takes money. So you're just in this constant cycle of, calling experts for favors or, calling King's Counsel and trying to pull a favor, get a preliminary opinion. And so we thought there's got to be a better way to fill this gap. So we raised our own fund, and basically that's all that we focus on. So we invest in things like soft book builds, KC opinions, legal fees, expert opinions, basically anything that a case needs in order to be more attractive and de-risk for the next round of funders. Throughout that process, as you can imagine, it takes time to get these cases going. A lot of times the cases that come to us, probably not too dissimilar that come to other funders, they're just half-baked. Maybe you see them and you can see the potential, you can see that it's a good idea, but they just don't have the time and the money that would really propel it to the next level. So that's where we try to focus. And then once we get those opinions back or the work that needs to be done, then we package that up and we talk to the larger funders to then take the case through litigation and write the full ticket for the full budget.
And how do you source those initial opportunities?
Again, not much different than probably your typical funds. It can come from lawyers, it can come directly from clients, regulatory action, cases in other jurisdictions that look good and are running, but a news article, probably about the same way that everybody else does.
We'll look at some of the kind of challenges with some of these secondary transactions, but from your perspective, when you hand over to one of the other funders, how involved do you still stay? Do you keep a strip, or do you hand over completely? Do you still kind of manage some of the information flow?
Sure. I think it really depends on who the funder is that's taking over the case and what their needs are. If you're a fully developed fund that's been running and you have your own investment managers and things, maybe you just want us to step out and hand the case over and you take it from there. If you're more of, maybe the credit side that doesn't have the in-house kind of legal specialty that's needed or investment managers to really manage the case throughout, then we can stay involved and, kind of fill that role. It really just depends on what the fund that's stepping in needs and what they've got within their kind of ecosystem already set up.
Okay. So it's not necessarily just specialist litigation funders. You might have other types of investors that and they might need a bit more
exactly. Yeah, and I think that this is a really great way to pull a lot more money into the market because you're not we can kind of serve that role as an investment manager to work up the case, and we can go to money that doesn't necessarily have some of that in-house specialty, and they get a fully baked product when it comes to them, and then they can just put their money in, which I found as a funder is typically what you want to do.
Thank you. I mean, that's the role being played there is so critical because, of course, without those cases getting off the ground, we're not going to really have much of a secondary market to work from.
Sure.
So interesting to hear the panel views on, obviously we've got one element there driving secondary market transactions and liquidity, but what else is kind of driving the development there?
I mean, at the risk of sounding like a broken record, funding hasn't changed much in the sense of duration always runs long, budgets always go up, claim value always comes down, and the structure of a lot of funders who maybe have closed-end funds, when these breaking points happen, it can be enough to kind of blow up the investment for the funder. So we see a number of phone calls coming from funders that are maybe kind of at the end or something is triggered within the case. That means, as a result, it's no longer efficient for them to run or continue to keep pursuing. So that is kind of three key drivers, effectively. And then on the other side, it's that kind of initial co-funding. People coming to us, sometimes even before they've signed a funding agreement with a counterparty, saying that they're looking to share the load with somebody, and cases have changed a lot. Let's take the CAP, for example. 5 years ago, the average CAP budget was probably between 15 and 20 million. Now we can see cases that are 25, 30, 40 million easily. And that is more than some funders are able to commit, prepared to commit. We won't even start talking about concentration risk. We'll save that for later on. But that, again, another kind of key driver. And finally, the market we're in, fundraising is difficult, and there are some funders out there that are trying to fundraise at the moment, but they have their own relationships, they are origination machines in themselves, and they have cases that they want to fund but maybe aren't prepared to fund, and will approach us and say, in theory, we want to front this, we want to run it, but we would like to have some cash that we can white label and continue to pursue, and all of that as well. It's worth saying it's not in any particular jurisdiction. That is everywhere. We're seeing it from all over. So kind of everybody is vulnerable and susceptible to those changes. And I don't think that this is just a phase. I think it's something that's here and it's going to continue.
Gian, any thoughts?
Yeah, I think that we need a secondary market to be functioning and healthy. And I think it's obviously a bit of a pipe dream for a while for the industry to have that. Having gone through the very public transaction Omni went through earlier that has been scrutinized quite a bit. I mean, there's three main learnings I had from that for Charles to be able to do more secondary. And I think the first is it comes out of data, costs, and valuation. I think the data is terrible across all funders, frankly. You're still receiving PDFs, Excel files, Word files, email updates from law firms on every single case. How that is aggregated and then transferred in a secondary transaction, it's just really difficult. So a big chunk of that big secondary that we all know about was DD, took ages. And if I want to make it easy for Charles to buy part of one of my portfolios, I need to be able to push a button and, as in an M&A deal, hand over a set of IFRS accounts with all the data that he can easily continue going on. The other bit is costs. It's still way too expensive to service our books. If you just look at, most of the funders actually in the industry are not profitable. If you look at how much it costs to service litigation funding deals, it's way more than a book of mortgages, way more than a book of NPLs. The solution isn't always just to increase fees because that reduces returns and that drives investors away. But the more that we can do to become more efficient on the servicing end, I think the more appeal this asset class will have to investors, particularly private credit investors that maybe have a less margin to play with on the return front. And then valuation. Yes, the Ares deal stamped this fair value concept, still rather subjective, but if we could all just agree on one way to value cases so that NAV is the same across everyone from an approach perspective, it would make it a lot easier, I think, to trade the asset, as we talk about trading these assets. Standardization in that way would be quite helpful, I think.
I think you're exactly right. And if we're looking to invest on a primary basis, we all have this really high bar of expectation to law firms that we want, a lovely memo, a clean budget, a counsel's opinion. We want all these lovely documents laid out in perfect format. And so when we're seeing things on a secondary, format, we kind of want the same rules to be applied.
Yeah.
We want to see, don't just give us a data room and say, all my monthly reports are in there and there's a load of spreadsheets, because we all have different modeling structures, different valuation, algorithms. We can't understand that if we're just looking at a data room. So having really nice, clean, laid out information is a key thing to getting these deals done.
Yeah. I think one of the biggest headaches to that secondary was, you had the big guns from the credit investor coming in to do the DD, and they'd find that you couldn't find that invoice from 2003 on this case that was, just concluding, and how do we know that the total you spent is that? Oh wait, we have this Excel file that is, it's corrupted, crap, and we laugh about it, but that's the reality across people who manage hundreds of millions of dollars, which in D. Shaw's world, right, or private credit universe that's coming looking at the space is not acceptable. So those are I think, the three main things.
Interesting. Stephen, if you could come in here. Gian's referred to a transaction that I think a lot of people in the room know about. We can maybe talk about that a little bit more later, and that was structured a particular way. It might be useful to come back a step and talk about what we see by ways of structuring secondary transactions. So from your perspective, how do you actually do a secondary? What does it mean in your institution?
Sure. Well, I think something that still remains quite far off, and perhaps so far off it's a pipe dream, is effective securitization of litigation funding. I think that I agree with Gian and Charles on what's required for effective secondary markets. You require standardized documentation and data, consistent across the industry valuation methods, and a relatively uniform approach to case selection and case management. And you need all of that on a sufficient scale to justify and maintain a securitization market. So I think we're some way off that. I also think that litigation as an asset class may not be amenable to securitization at all. So I think we're far off that. I think what is working very well is what might be described as syndication. And really by syndication, we mean one of a small number of things. There are three types of ways in which I think litigation funders today are approaching the secondary market, the primary drivers. The primary market is approaching the secondary market. The first is distress. There are some litigation funders who run out of money, or distress otherwise causes them to need to access the secondary market to keep the cases alive and to keep them going forward. So thankfully, whilst there has been a lot of distress in the market over the last year, that doesn't include Woodsford. We're thriving, so that's not why we're accessing the market. There's a second category of secondary transaction that Gian has referred to. That's a type of continuation fund where duration has caused a manager to need to create a secondary continuation fund, allowing some of the old funders to get cashed out, allow some new funders to come in, but with the manager remaining in place for their remaining assets up to resolution. Woodsford isn't a fund manager, we're a balance sheet funder, so again, that isn't a category of secondary transaction that we're involved in. The type of secondary transaction that we do and have done for many years very successfully is what we term as sub-funding. I draw a distinction between co-funding and sub-funding. The distinction I draw as co-funding, as Charles alluded to, is when both funders come on the scene at the same time. They are both a party to the direct litigation funding agreement with the funded party, and they both have shared risk and reward from the outset and with direct exposure to the litigation. Subfunding, which is a type of secondary market transaction that at Woodsford we've done very well for a number of years, is where the primary litigation funder enters into the litigation funding agreement, gets exposure to the litigation, has the relationship with the funded party and their law firms and so on, and then later in time invites a subfunder to enter into a bespoke contractual agreement, a subfunding agreement with the primary funder, giving the subfunder indirect exposure to the litigation. They don't have direct contractual privity with the funded party. Their interests are derivative of the primary funder. We use that for risk concentration management. We pursue a diversified portfolio. We avoid concentration in any area that might have systemic risk. So, for example, we avoid being too concentrated with a particular defendant or a particular claimant law firm or a particular area of law where one judgment could affect a number of cases. And so if we see in our portfolio that we're becoming concentrated in any such area, there's two key things we can do to manage that risk concentration. The first thing that we can do is increase the amount of exposure that we have to other areas, thereby diluting the concentration, or we can sell off some of the risk in the concentration area using subfunding, and that's a very effective way to use the secondary market. We're using that right now with a small number of trusted partners who are themselves relatively sophisticated in litigation funding, who understand the dynamics of litigation, who often themselves are also in the primary litigation funding market and therefore have a high degree of sophistication on what's going on. And that's what we use secondary market transactions for.
And is there consensus on the panel that subfunding is generally the most prevalent form of secondary transaction on the market?
I would say so. And we're seeing it for various different reasons, all of which kind of Stephen touched upon, but concentration is one of them. And if we take the cat, for example, I'd probably bet my bottom dollar that almost every funder in town has got, an amount of cat exposure. And, it's hard to manage. There's been a lot of talk already about, CPI and can CPI, protect your concentration? Well, maybe. Or is it a case of, let's syndicate this out and speak to a larger fund, a hedge fund, a credit fund, or another funder? The key really is around alignment. It's around control. How involved or how passive is the subfunder going to be? Are we going to have any interaction with the law firm or the counterparty? These are all kind of things you have to try and factor and understand. And likewise, when it comes to valuation of these claims, we've seen some where a firm has said, this thing's going to settle for 500 million, and you just think, well, that would be great, but that's never going to happen. And trying to gather these realistic expectations of what may happen, and it's not as easy, but as Stephen alluded to, if you have trusted partners that you've done this with time and time again, then they do work.
I think you mentioned levels of influence that you may have as a subfunder, I guess. I think it's critical to the industry that we do this more often. All of our transactions, where they're technically over $10 to $15 million in size, we co-fund out to our LPs and other co-investors, and that's half of my job. Is a job in and of itself is running these processes. I think, and for us, it's more convenient that the investor is silent. It gets a bit more complicated. You can't really have two funders on a CAD. Like it gets all a bit messy. So we have information rights in between us and the investor, but it's cleaner if in my view, if there's a lead funder that's leading the case, and it allows us to be a bit more efficient. But I think the one thing that has stuck out to me is, as we have all started to do more subfunding or co-funding, again, this is not something we're inventing, right? It exists in all these other asset classes. There are processes that we should copy from other asset classes that do this all the time. And I'm kind of surprised that some funders, there just isn't a process. Well, we saw a casualty the other day of another funder who was kind of victim of their own concentration risk management. And there, we would get phone calls when the LFA was already signed. And it's like, these conversations need to happen when you are at the term sheet stage. so that everyone else has time to do DD and everyone else signs the LFA together. Or the participation agreement is signed when you're signing the LFA. Because I know that if you're calling me with a 20% portfolio position problem after you've signed the LFA, my incentives are not to give you the terms that you want, nor is it my incentive maybe even to sign that. So I think we all need to kind of work a little bit better, I think, on the process side of things to get maybe a bit ahead of the ball on these. And it's happening more and more, but I think it's a good thing for us to be doing that.
You're exactly right. We're better off being phoned as early as possible, because if you're coming and asking for cash post signing of LFA, that maybe you can't actually meet the terms of, this is more of a distress position for you. And I completely agree that why are we going to look to agree the same terms when, if anything, you're stuck? So come to us, earlier. We haven't got to have loads of phone calls with the lawyers. We haven't got to get involved with your client, but we can ask the right questions. We can try and steer things in the way we want. And ultimately, we've also been doing this, a long time, and we have our own views on how things can be structured and monitored and underwritten. And the more information we can share in setting these sub-funding deals up, the better.
So, common theme there is concentration, diversification. In a lot of ways, that sounds a little bit like downside protection, but obviously, Caroline, from your perspective, you're seeding these cases, obviously for upside. And how does that handover look versus, if we're using trading parlance, we've got 3 sell-siders here, one including yourself. How do you pass on to that next funder, kind of monetize your initial seed investment?
Yeah, well, and, we've heard a lot about CPI, I think, on some of the other panels, and that's certainly an option in the majority of these cases, right? Obviously, it can be cost prohibitive, or it may not make that much sense in a certain scenario, but we did a 10-case portfolio that we wrapped with CPI insurance, and it also had, which is probably the biggest term we've heard up here on every panel, is duration, right? So if you can add that duration protection, so that particularly if you're in a newer jurisdiction, or maybe a jurisdiction that just hasn't had things tested as much, or hasn't had as many rulings come out to give that certainty, if you can add that duration protection insurance as well, then that takes off one huge question mark that every single funder looks at in every single case.
So not to labour this kind of transfer of risk process too much, but what I'm hearing is fund level secondaries not necessarily super attractive due to complexity, cost, sub-funding very comparatively efficient. We're not really talking about true co-funding that much. Are there any views on the panel as to, I don't know, maybe some of the downsides of true co-funding, as in maybe like a club of lenders or 2 lenders fronting on a primary basis?
Maybe Steve and I maybe are using these words interchangeably, but sub-funding, co-funding, kind of something to me.
So distinguishing sub-funding where you have one primary funder, then having back-to-back relationships with a number of sub-funders who essentially remain anonymous to the other parties to the LFA, versus multiple primary funders visible on the LFA.
I think it's more of a elegance of the solution. I don't know about everyone else, but I just think it's easier if there's just one funder on it. It just takes less paper space.
And the voice you were saying as well. If you've got
no, but also, I think also if you're involved in the case, you're not going to, I just think it gets more complex the more people you have on the LFA. It's cleaner. You can, between 3 funders, for example, manage a case together behind the scenes. I don't really think it makes much difference, really, if the participation agreement is structured correctly. And these things have become pretty boilerplate, that you should be able to do it efficiently and without much headache. I think that the question about the funds point, I'm curious, maybe from Charles, if you've seen a bunch of these, but there's only so many funds, right, out there. Not that many, and you need to find them at the right point in their life cycle. You need to find them at the right point of deployment. If we take, a funder right now that may be needing a secondary. Well, if they've only deployed 15% of their fund, that's, on what basis? Are you just assuming commitments, or is that 15 million of deployment or 15% of deployment worth more than 15%, to your point on valuation? So I think these things need to be right time, right place, and they're not all over, right? It's not like the secondaries market in private equity. So it's just, again, if we solve the data problem that I mentioned before, I think it'd be a lot easier. And we would, Charles wouldn't spend 6 months trawling through data rooms on 50 cases to get to a conclusion, right? That's still a big obstacle.
I think it's adverse selection is a major risk when you're working with another funder on a secondaries position, because they're always going to want to keep their best cases. They're the ones that they're not going to want to hand out. If they think it's going to win at trial, or they think it's going to settle in the next 6 months, they're probably not going to come to you and say, hey, you can take this one off us as well. They're going to give you maybe the stuff that's fresher or the stuff that's a bit spicier, and you have to kind of really take with a pinch of salt when a funder says, hey, I'm in trouble and I've got all these cases. Maybe look at these ones, but don't look at these. That's a major red flag that goes up.
It's kind of the same thing Rosie was talking about earlier, just on a different level, because she was talking about it from a law firm perspective to what funders actually see, and now you're going from a funder perspective to, secondary. It's a lot of parallels.
Yeah, I think you're always going to want to keep your best stuff. And if we're coming in and we're looking to take on a secondary position, we have to understand that there's a risk dynamic that's swapped. And that's where kind of the fees and valuations come in, because, okay, you may have ran this case for 5 years and you've jumped a couple of fences, some preliminary issues. However, your main binary risk is trial, and you're looking to offload it pre-trial. So if we're going to come in and take this on, okay, we don't necessarily have duration risk because trial's in a year. However, we have sole binary risk, and our pricing is going to be reflective of that. And if we're maybe taking this off your hands, my argument's always going to be, well, what risk have you really taken to this point? You may have invested X million, but we all know that the major cost is at trial, counsel's cost, more insurance, whatever it may be. So valuing these things at what point we come in also massively changes.
But ultimately, what everyone seems to be agreed on is that these are highly bespoke transactions, that we're some way away from sufficient standardization where there's an effective securitization or other standardized market. And going to your question, Iden, about the preference for sub-funding where there's a funder obviously in control rather than co-funder where there are multiple people with direct interests, I see a definite preference for all concerned for the sub-funder strategy. An expression that I've used before is if you have more than one funder trying to grab the steering wheel, somebody's going to crash. You need to have somebody who is obviously in control, and if it's a bespoke transaction between trusted partners, that will end well.
So, Charles, from your perspective, binary risk, but also you assess counterparty risk, who's actually fronting that, given the dynamic that we've been discussing where we don't want the sub-funder to be interfering too much. It gets a bit messy when that happens. But you also want to protect your own interests at the same time. So how much importance do you attach to your primary funder that you're going to be sitting behind?
Oh, I mean, it's everything. There's a lot of funders in town. There are some that we would fund. There are some that we wouldn't fund. And when we're looking at it, we're trying to understand the track record of these firms. How often do their cases go to trial? What's their success at trial? What has their management been up until this point? Has there been any leakage in terms of downside? It's really, I mean, I've been on both sides, kind of buying them and selling them. And, so I can kind of see each unique position. I mean, if we talk about if you're maybe selling a position, it's really important that whoever you're selling it to actually understands the asset class as well, because they're going to jump on monthly, quarterly calls with you. They're going to ask a lot of questions. And, there are instances that I've heard of where they've sold it to a big credit fund who's never really done litigation or any kind of legal asset before. And they're asking what seem to be pretty basic questions or the most ridiculous questions. And you're going to pull your hair out thinking, you own this. How are you managing this? So it's really important on either side that you know kind of who you're getting into bed with and that you really trust that firm.
And on the other side of the coin, Stephen, you mentioned you've got a trusted group of sub-funders, and Gian, I'm assuming you have a similar setup of contacts that you can go out to quite quickly. How does someone get into that club as a new entrant to the sub-funding market? Because why are you going to spend the time and effort to kind of let someone else in if you've got a trusted group of 5 people that you can generally go to fill a position?
Yeah, I don't think it's any different than any other commercial or professional partnership. It comes from businesses that have something about them that obviously leads to trust. They have a track record of success in something. They have a network and a contact that you recognize. And frankly, in the market, the secondary market for litigation funding, the great success comes with the sub-funders, the secondary market participants who understand litigation. You can smell a mile off a potential partner who is kicking the tires and doesn't really know what this asset class is. And there might be a temptation to say, oh, well, I've got dumb money here, I should go for their dumb money. I don't think that's going to end well. If somebody gets unwittingly into high-value complex litigation, they might transact quickly, but marry in haste and repent at leisure.
I think maybe I run a less exclusive club, but I think the important thing for me is I want liquidity and depth in the market, so I try to have a long list that I shorten based on the case or the opportunity. Maybe a CAT case is more fit for a certain investor. Maybe a portfolio is different for another one. Maybe we tranche it into 2 and somebody takes a senior position and we keep the junior position, whatever it may be. I think the most important thing is, do they have the money and can they honor the commitment? Because the worst situation is that you're funding a CAT case and you find out that your sub-funder doesn't have the money to fund with you, 2 years in. So I think that's credit quality, reputation, all that stuff is super important. I try to have a rather broad remit or list of potential partners for that reason. And actually, I don't know, Stephen, if it's different for you, but actually there's a minority of other funders on it. It's actually mostly not pure play litigation funders on that list. I think mainly because of we kind of like to run the litigation, and so sometimes we don't co-fund because, well, actually we have a different opinion of how that should be run, and we'll just get annoyed sitting in the back, not being able to say anything. So that's a part of it, I think, and having investors that are a bit more flexible.
Yeah, so I think that's right. I think whilst it isn't necessarily all pure play litigation funders, there's definitely a preponderance of people who understand how to extract value using a litigation process. Investors who understand distressed corporate investing, sovereign debt, who aren't green to the vagaries of litigation.
And maybe they're more appropriate for coming in on a secondary, on a portfolio, rather than single case, where you might expect, single case a bit more scrutiny on the actual litigation analysis versus statistical analysis on the portfolio.
Yeah, I mean, our experience has been that single case secondaries, there's just a higher transaction rate on those. There's a lot of attraction to portfolio funding and a lot of talk about it, but execution is very difficult. And if you've got a track record of success doing mutually optional bilateral sub-funding with trusted partners, it works well for us.
We touched very briefly on CPI earlier. Where does that come into play in the secondary market? How does it help? And maybe how does it hinder?
Where do you want to go first?
Who wants to go first?
Caroline, you can take credit. I know you guys did a CPI-backed deal.
Yeah, that's the portfolio I was talking about earlier. That was on 10 cases in a fairly new jurisdiction, and so it made sense there. I mean, Charles and I were having this discussion a few days ago about just kind of what the risk tolerance is, and if you're really doing all this due diligence and you price everything appropriately, do you really need insurance? And I think the answer is, whoever said earlier, but from a lawyer's perspective, is it depends. right? I mean, it's always going to depend on just kind of what your expectations are, what your risk tolerance is. Our risk tolerance is very high because we know when we're coming in, it's before quantum is known, it's before there's an expert on board, all of those things. But I understand that not everybody's is at that same level. So I mean, I certainly think that it has a place in what we're doing and in the litigation funding space. And I think there's some really great products and some interesting products that are continuing to develop from the insurance side of things. So it's kind of like a watch the space thing, because I think we're going to see it more and more, particularly if there are ways to price and kind of get the equity returns, but without that downside risk.
I would say Omni is a big user of insurance, and have in my career now, not decades, but long enough, I guess, that had bumped into CPI quite a bit. And I would say to the private credit investors in the room, what I understand from your transaction is critical who you're doing this wrap with. It is really important, because I love insurers, but we haven't seen payouts on these CPI policies. There certainly are disputes, right? Oxford in the US, Aon getting sued, like they are taking their time to pay where they need to pay. So I just think everybody needs to really walk into these things eyes open. You have to do your due diligence. You've got to look for the rating. You've got to understand, is there capital in the box? Did they move the capital out of the box when you weren't paying attention? Has happened. So I think we need to really watch our toes and watch our fingers on this. It is helpful. It does reduce duration risk. It does reduce downside risk. But it doesn't help you if you're being insured by an unrated Bermudan entity that you never heard of. So you have to have a good broker, I think. I think you guys were advised by a really good one, so that's super important. But I just think we need to be careful viewing it as a panacea to like all liquidity entering the market. I know they'd love to receive your premium, but if they don't pick up the phone 5 years from now, don't be surprised, right? I mean, I think you just need to, the same way that claimants approach us as funders and we approach claimants with that due diligence mindset, we need to do the same thing for that.
Yeah, someone described it to us as just like be wary of the Swiss cheese, because I mean, everything is in the policy and the exclusions, right? And so diving into what the policy actually says and what the exclusions are is going to be completely, the most important thing that you do, so that you make sure that, you're not somehow having that policy lapse because, you didn't read something properly or they excluded it. But that is if you're getting any of these policies, I would say reading those exclusions is one of the most important things you can possibly do.
You'd say your credit fund, you got $50 million wrapped in this thing, and this manager's ticking along over here. I have been in a situation where 2 years in, the finance guy forgot the Q3 report and didn't send it to the insurer, and boom, technically, policy's lapsed. You got really good lawyers to reel it back, but the point is that can blow up the whole thing. So if you're putting like 5 of these into your $1 billion credit fund, be aware that that is a way to blow the policy up. So you need to have a good system, software, whatever it is, to make sure that there is no excuse for missing that, and there's no excuse for the insurer to say, hey, you didn't send me the information. Email is terrible. Don't use it, right? Find something else. So it's just a word of warning.
Yeah, I mean, I would add, I'm also a fan of CPI. I think it absolutely has its uses, but I think it should only be used in the right circumstances. So if we're looking to take a position where we're sub-funding with somebody in one deal, that doesn't really make any sense to seek CPI. A good trade is a good trade, and you should kind of back your underwriting and back what you're doing. If you're taking on a big portfolio of these from another funder who maybe has looked after these 3 or 4 cases for a number of years, that could be a good thing to CPI, because there's a lot that's gone on that you haven't seen and had the day-to-day kind of workings on. So I kind of agree with the Swiss cheese piece. I tend to sum it up as the difference between American football and rugby. You either wear a helmet or you don't. And if you like the investment, you should back your investment. But on a wider portfolio basis, where maybe you haven't had the full picture, then it can really benefit.
I can see that. It's a sensitive topic, that one. Maybe one last question to the panel before we invite questions from the audience. We've be remiss if we didn't mention AI at least once in every single panel conversation. Have you seen any great use cases, innovations in data analytics, let's say from a pricing perspective or diligence, implementing some technology there to speed up your process or give you a level of confidence? If not, fine, we can move on. But it would be interesting to know if that's coming into play more as well.
Should we go down the...
So on a business level, we're definitely seeing efficiencies brought by AI, but nothing transformational yet.
Okay.
I agree with that. I think there's certainly efficiencies between just summarizing things and kind of getting it, just taking the amount of time that it takes to do something and shrinking that. But from a consistent diligence perspective, I don't think it's anything that we would 100% rely on.
I mean, I'm a technophobe, so I had no use for AI. It's not something that has factored into our decision making at all, and I'm not sure it will.
I think it's a really helpful tool. I think it's really good in due diligence to ask it lots of questions, because I find that on the first cut it's often wrong, which is surprising. As a good example, people are following the motor finance stuff. The FCA released their consultation documents, right? 600 something pages of stuff that consumers don't need legal advice on. I put into ChatGPT, for example, not the free version, and said, summarize this and tell me what the main conclusions are. And the main conclusions, I then went and read the documents, and it was completely wrong. So if I had just taken that and said, oh, guys, this is what we now need to do with our investment, I would have been in big trouble. I think we're going to make strides and all that, but, use your brain, I guess.
Yeah. So there is increasing sophistication, but still some reliance on human judgment and analysis, which I'm sure all the professional advisors in the room will be very happy to hear as well. So we have got a couple more minutes left. We're happy to invite questions from the audience. Can we get a microphone over there?
This is a question about form on subfunding. Are there particular covenants that the claim owner or law firm should seek with respect from the funder in the original LFA with respect to subfunding? For example, notice of discussions with the subfunder.
That's a good question. Stephen, you want to...
Stephen,
I mean, I'm not minded to advise anyone to negotiate against me. We've had absolutely no problems on this front. Subfunding has been done for a number of years successfully, hasn't caused any problems, and it is have no real relevance to the law firm and the claimant if done properly.
Sorry, I was just going to add that I think because of some of the restrictions with, cases can't be funded by competitors or, there's some of those things that would potentially knock the case out in some jurisdictions. Those would be something that I would think about putting in, just that, any subfunder that would come in would not hit one of those things that could be a disqualifying event for the cases.
Yeah, just remember, for the claimants and the law firms in the room, thinking about, is subfunding bad because then is there more risk of them not being able to pay because all the stuff. The onus is still on me, funder, to pay. If my backing subfunders back out, this is my problem. But also, we're doing it to reduce the cost of funding overall, right? If I can't and I have to take that whole risk, it's going to be more expensive. So the flexibility to do it, I think, is really necessary. I'm sure under Friends we can talk about who we're going to approach, or we can say we will self-fund it. We're open about that with investors. In very large claims, we say upfront, this is going to be more than one legal entity that is providing you capital. But rest assured, when you sign that LFA vis-a-vis a funder or that law firm loan, that counterparty in the LFA is who owes you the money. Still on the hook, even if they ask somebody else for some help on the back end.
Yeah, and I think just to finish off that point, if we look at some parallels with the credit market and the broadly syndicated market, there are very different drivers there to why a sponsor borrower might want to have those types of restrictions. Although personally, if you have a silent participant that has no conduct rights, I just see it as a way of reducing liquidity at times when maybe you need a more liquid market. Even those considerations, I don't really see them applying in the same way in an LFA situation, given restrictions on conduct rights of the primary funder. And again, not the similar types of situation that we see in the credit markets with going into a particularly contentious restructuring, for example, and that's why a sponsor borrower may want a bit more visibility and tightness around letting in sub-funders, but I don't see those same parallels in the litigation funding market.
This is a question a bit to the two sides of the panel, the sub-funding side and the seed funding side. Am I right in understanding that the sub-funding dynamics tend to go for bigger funds progressively, or funds that are able to absorb more risk? And if I'm right with that, what could be done at the seed stage so that the dynamics later are opposite, that it goes into more of a distributed funding dynamic?
I would say, I won't talk for your seed part, but seed funding can reduce a lot of that kind of initial risk and cost exposure, so around things like book building, etc., which can sometimes run quite long periods and can also run up sometimes quite substantial sums of money. When it comes to sub-funder, it's not exclusively linked to big hedge funds and big credit funds. Funders go to other funders of all shapes and sizes. It's not exclusively reserved for $50 million budgets. It can be a $5 million budget that someone is just looking to buddy up with someone with, just due to their own parameters or concentration or generic exposure.
I think we're at time now, so all that remains is for me to thank our panelists for a very thoughtful and forward-looking discussion, and to thank our audience for joining us.